Hey everyone, and welcome back to the channel. Today we're diving deep into the latest financial report from one of the world's most renowned carriers, Singapore Airlines. The numbers for the second quarter are in, and they paint a pretty dramatic picture. So, what's going on with the airline giant? Let's break it all down. On Thursday, Singapore Airlines announced a staggering 82% drop in its second quarter earnings. This was a huge miss compared to what analysts were expecting. For the 3 months ending in September, the net profit came in at just 52 million Singapore dollars. To put that in perspective, the market forecast, based on LSEG smart estimates, was for a much healthier 181.47 million Singapore dollars. That's a massive gap between expectation and reality. Revenue also fell slightly short, clocking in at 4.89 billion Singapore dollars against an expected 4.94 billion. It's not a huge miss on the revenue side, but when you combine it with the profit plunge, it definitely raises eyebrows. So, what's causing this turbulence in their financial results? The airline pointed to two main culprits: a significant drop in interest income, and, more notably, heavy losses stemming from its stake in Air India. Let's look at the first factor. Interest income fell by 42 million Singapore dollars. The company explained this was due to lower cash balances on hand and recent cuts in interest rates. In a high interest rate environment, large cash reserves can be a nice source of passive income for a company, so a dip here definitely stings. But the bigger story, the one really weighing down the balance sheet, is Air India. Singapore Airlines associated companies, with Air India being the primary one, collectively posted a loss of 295 million Singapore dollars in this quarter alone. This is a huge figure that essentially wiped out a significant portion of potential profits. To give you some background, Singapore Airlines acquired a 25.1% stake in Air India. This happened as part of the merger between Vistara, which was a joint venture between Singapore Airlines and India's Tata Sons, and the newly privatized Air India. The deal, finalized in November 2024, was seen as a strategic move to gain a strong foothold in the massive and rapidly growing Indian aviation market. Starting from December 2024, Singapore Airlines began accounting for Air India's performance in its own books. Unfortunately, Air India is currently undergoing a massive and costly transformation. The airline has been struggling for years, and turning it around is a monumental task. Singapore Airlines stated that despite these challenges, they remain fully committed to their partnership with Tata Sons and are dedicated to supporting Air India's multi-year transformation program. They knew this would be a long-term project, but the short-term financial pain is proving to be quite severe. This isn't the first time Air India has been a drag on Singapore Airlines' results. It was a similar story in the previous quarter. The situation with Air India has been further complicated by a tragic event. According to a Bloomberg report, after a devastating crash in June that claimed over 240 lives, Air India was reportedly seeking at least $1.1 billion in financial aid from its owners, Tata Sons and Singapore Airlines. This financial support is desperately needed for critical system upgrades and to build up in-house engineering and maintenance capabilities, areas that are crucial for ensuring safety and operational reliability. As a 25.1% stakeholder, Singapore Airlines would be expected to contribute its proportional share of this funding, adding another layer of financial pressure. This shows that the investment in Air India is not just a one-time cost, but an ongoing financial commitment. Looking at the bigger picture for the first half of the fiscal year, the trend is consistent. Net profit for the first 6 months was 239 million Singapore dollars, which is down almost 68% from the same period a year earlier. This really highlights the sustained pressure the airline is under. Now, it's not all bad news. Singapore Airlines isn't just sitting back and watching its profits decline. They are actively making strategic moves to strengthen their network and competitive position. They've been busy expanding commercial partnerships to drive future growth. For example, in September, they launched new codeshare services with Vietnam Airlines. This move is designed to bolster their presence on key routes within Southeast Asia, a region that continues to see robust travel demand. And just last month, in October, they deepened their existing joint venture with the Lufthansa Group. This expansion now includes Brussels Airlines, which significantly improves connectivity for passengers traveling between Europe and the Asia-Pacific region. These partnerships are smart, long-term plays. By sharing routes and passengers with other major airlines, Singapore Airlines can offer more destinations and more convenient connections, making their network more attractive to travelers, without the massive capital expense of buying new planes and launching new routes all on their own. So, what does the future hold? The airline mentioned that demand for air travel remains resilient, especially heading into the peak travel season of the third quarter, which includes the holiday period. This is a positive sign. People are still eager to fly, and that fundamental demand is what keeps the industry moving forward. However, Singapore Airlines also issued a strong word of caution. The path ahead is not without its challenges. They pointed to several headwinds that the entire airline industry is facing. Geopolitical tensions around the world can disrupt travel patterns and increase operating costs, like forcing longer flight routes to avoid conflict zones. Macroeconomic headwinds, such as the risk of recession in key markets, could dampen consumer and business spending on travel. Then there's the issue of inflation. While it might be cooling in some places, cost pressures remain a major concern. Everything from labor costs to catering services is more expensive, and these costs eat directly into profit margins. On top of that, supply chain constraints continue to be a problem. Delays in receiving new aircraft from manufacturers like Boeing and Airbus, or even shortages of spare parts, can hamper an airline's ability to expand its services or even maintain its current schedule. And let's not forget the air cargo market. During the pandemic, air freight was a huge and highly profitable business for many airlines, including Singapore Airlines. However, the carrier warned that trends in air cargo are now uncertain. Shifting trade policies and general market volatility are making it difficult to predict future demand and pricing for freight services. This was once a reliable revenue stream, but it's now become a source of unpredictability. In conclusion, Singapore Airlines finds itself at a complex crossroads. On one hand, the core demand for passenger travel is strong, and the airline is making smart strategic partnerships to position itself for future growth. On the other hand, it's being heavily weighed down by the immense financial burden of the Air India turnaround, coupled with a host of external challenges facing the entire industry. The huge drop in profit this quarter is a clear wake-up call. The investment in Air India was always a long-term gamble, a strategic bet on the future of Indian aviation. Right now, Singapore Airlines is paying the upfront price for that bet. The key question for investors and industry watchers is, how long will it take for that bet to pay off? And can the airline weather the current storm of high costs and external pressures in the meantime? The coming quarters will be crucial in answering these questions. What do you guys think? Is Singapore Airlines' strategy with Air India the right move for the long run? Or is the short-term pain too great? Let me know your thoughts down in the comments below. I'd love to hear your perspective. Thanks so much for watching. If you found this breakdown helpful, don't forget to hit that like button. And subscribe to the channel for more deep dives into the world of aviation and business. I'll see you in the next video.